Great, that's it. That's it. So, ladies and gentlemen, thank you for being here on this rather mild January day, and welcome to ByteTree Premium. That's the point of today. I'm going to mention a few strategy ideas that the multi-asset investor is going to be looking at in 2023. A few of the high-level important points. We'll do other more detailed ones later on different themes that as they arise. But right now, we'll just keep it a sort of 30,000-foot view. And I want to just show you around what ByteTree is and why it is and all the rest of it. Give you a helping hand on making sure you get your settings right, because I want to make sure that you're getting the things that you want. If you love crypto, it's all there. If you hate crypto, that is fine. Turn it off. Make sure you don't receive it. So ByteTree is there. It's got something for everyone, but I think we're all different. So let's just kick off with a few strategy ideas for the year. And I'll start with a sort of risk warning that, nothing we say has got anything to do with investments whatsoever. So please don't mistake that. This is pure entertainment. So this is our first slide. We're going to look at bond and equity returns over the last 100 years. This slide was very popular late last year as if shock horror, it never happens. Well, I use a 30-year bonds here, a sort of synthetic return. And actually, negative bond years are more frequent than many think. But there's no doubt about it that in the bottom left, where both bonds and equities are down, we are in standout territory. And the interesting thing about all those years, 31, 74, and 22, what followed was all pretty good, actually. So, when lots of things have gone down in a short space of time, there can be an opportunity the following year. Does that mean there definitely is? No. It could be the prelude to another bad year. Who knows? But on average, over time, good news tends to follow the bad. Buy low, sell high. Simple bit of thinking there. And I just made the point in one of my pieces, I can't remember which one it was, but in 82, 85, and 95, all of those times really followed pretty nasty sell-offs in bonds in all cases. And it's just, you had all big rate hikes, I think is what I was pointing out, actually. And after the big rate hikes, when you get the relief, prices have adjusted into that nasty environment. And then finally, sooner or later, they sort themselves out and everyone's happy and goes home with a balloon. So what have we seen in the 21st century so far? And these are total return charts. So the major stock markets, emerging markets, Europe, FTSE All Share, and the S&P 500 in purple. The gold price, obviously that's without dividends, there aren't any. And then black, I've cheekily put in US M2, the money supply. And I don't really talk about that much, but I think you can't ignore the fact that somehow or other asset prices have kind of reverted around the amount of money in the system. Now, that's not a conspiracy theory there, because the amount of money is normally linked to prices in general, and it's normally linked to some kind of GDP number, some kind of nominal GDP. It's dislodged in recent years, which is one of the issues that we have to face. But nevertheless, you see that over the last 20 years or 22 years, gold's at the top of the list. The purple S&P is just below money supply, 4 times your money. But notice that only started post 2015-16. Before that, the S&P was in the pack. So we know what caused that. It was the dot-coms, the new dot-coms, the tech stocks. Prior to that, emerging markets have very much been in the lead. But they've spent the last 10, 15 years really going sideways. And hence one spots an opportunity. And the same is true for sort of US, UK, and potentially Japan, which has just done so little in such a long time that the valuations are pretty attractive. And people sort of think that investment in years like 2021, 22, or years like 99, 2000, it's all about inventions. It really has got nothing to do with inventions. It's about real returns. And data show it time and time again that is true. So I'm going to show you the same slide over 10 years. And it's pretty interesting, because suddenly the S&P blows out the water, and there it is, way ahead of everything else. And everything else is behind M2. So if you kind of mean revert, and the stuff that hasn't done very well over the last 10, 12 years starts to perform, and the things that's done too well, then I think that's a very simple way of expressing what my views would be over the coming year or two. And we can show this in so many ways because the US is overdone. If we look at, all the equities and bonds or government bonds as a percentage of market capitalization, as a percentage of GDP in the United States, you get this huge number, and it's nothing like that as big as that elsewhere. Now, it's hard to get data like that. This is rocking horse, what's it? And it's something I've been collecting for years in bits and pieces and put it together. So how I don't know how you get this for most countries, but it's very clear that in the US the value of financial assets compared to the real economy is huge, and we just call this financialization. I think that's probably the best way to describe this: the financialization of the economy, which presumably is not really very real. Some people are talking about credit conditions. This is credit spreads, and credit spreads obviously blow out at times of stress, most notably the early 30s and the Great Depression, the credit crisis, and also the early 80s. And the early 80s, that recession, that was at the end of a long period of inflation and very high interest rates. So that sort of 1982 spike, if we were to get one of those, given we're probably in the equivalent of about 1973 on that analog, it could be a few years away before we see that sort of thing. But actually, credit conditions right now are still not massively tight, but they're probably slightly above average on a long-term basis. But yes, there's a problem potentially with bankruptcies and delinquencies and those sorts of things. But right now, we still have very high employment, which is one of the problems for the policymakers, because they want to see inflation come under control, and that's unlikely to happen whilst people are demanding wage rises, which comes from a society in full employment. Then we've got a dollar bubble. All of these things come together. We've got the financialization of the US. We've got a very high stock market. We've got a very high currency. This chart goes back 50 years. It's purchasing power parity. That basically means if you fill a supermarket trolley, which includes a few other things like rents, and do your supermarket sweep, what can you get in one country versus another? And right now, you don't get much in the United States for your money, whereas in countries like Japan and Sweden, you get absolutely loads. In Britain, you did get quite a lot a year ago, or sorry, 6 months ago, but that's now closing slightly. So overvalued currency in America, overvalued market. It's taken up a huge share of all global asset prices, and the unwind is going to be pretty significant. Looking at the individual stocks, I think it's just quite fun to look at this trillion-dollar concept. Some people have seen this chart before. I've actually never put it in the multi-asset investor. I don't think. I've just put it on Twitter. But I've removed Saudi Aramco because it's a bit messy and a bit different. But you can see the high correlation of all of these dot-com stocks. And at one point there were 6 above $1 trillion. Poor Facebook or Meta only made it for a couple of days, but back down to 344 billion, which is still loads, which is still a huge amount of money. Tesla went up there for a bit and is straight down. Amazon might have surprised people to be third to go back below that line. Looks like Google's next. And then who will be Apple or Microsoft? Who knows? But I think that both of them will probably end up. I think all 6 of these things will end up below the $1 trillion line before this is all over. But this isn't a problem for everyone. You've got to remember that this happened in the 2000-2002 period, and boring stocks that were left behind, including emerging markets, didn't go down. Yeah, this is a big rotation in markets. And the final one to really illustrate the scary story of the US is the Cape-Shiller ratio, P ratio. And quite simply, that blue line is, and this is updated to last month, is still a very, very high number historically. We're still at valuations commensurate with market tops rather than market bottoms. So avoid US equities is my mantra. And that's probably why I found it difficult in the end to hold even Berkshire Hathaway, which is probably the best way to hold America there is. Now, being a bit more upbeat, here are a few opportunities. Value versus growth. Value's been underperforming growth for 10 years or more, and that turns the corner. We've got the same thing in UK, and this is actually the FTSE all-share chart, but relative to the world, so it's underperformed the world quite a lot. But that's going to outperform now. And the same is true for Europe as well. We haven't talked much about Europe because it's so similar to the UK, despite Brexit, that it will mean revert, and they'll both enjoy a recovery together. The main culprit, I think, has been the gas prices in the last couple of years. This is US gas in red, the natural gas future, and the adjusted as a sort of therm BTU conversion, which hopefully I've got right in this chart. I must have done because they touched many times before 2008. But the good news is that the price of gas over here in Europe is collapsing, having been a big problem over the last couple of years. So that's very good news. But there's still a competitive gap. It's still 12 times more expensive to carry out industry in Europe than it is in the United States on this differential. So we do want to see this gap close, and then there's absolutely no reason for that for that advantage to continue that they've enjoyed over us. But again, this is overpriced in assets. Then we've got the emerging markets going back 30 years, these wonderful cycles, 2000, 2011, just straight up. And that's what you wanted to own in that era. The same in the early 90s. And then the times you don't want to own emerging markets, like the late 90s, which we had a growth bubble, and recently where we've had a growth bubble. So as that reverses, I just think this is a bit of a no-brainer. How emerging market shapes up, I don't know, because it's one of those ghastly terms where one size fits all. Are we talking about what happens in Eastern Europe? Russia and Eastern Europe, by the way, used to be in the same basket. Now they're completely different. Then you've got the new petro companies. So the Middle Eastern companies like Saudi and Kuwait have actually become liquid markets, which wasn't the case 10, 15 years ago in quite the same way. You've got Latin America that's on a very different trajectory to much of Asia. And then, of course, we've got that question of, what the hell does emerging mean anyway? How can you call South Korea emerging or Taiwan emerging when they're wealthy nations? And of course, and Saudi's a wealthy nation. And of course, but these are all technical definitions by index companies, and it's about capital controls and shareholder rights and these kind of things. So it doesn't just mean a country that's trying to catch up. I think that's probably more a frontier market, which would be sort of Africa or Vietnam or one of these kind of places. And then I suppose the question mark for all this is Japan, which is good old Japan. Been underperforming the world index now. Is it actually peaked? There's something wrong with that chart. I apologize. I'm not quite sure what's wrong with it, but it did actually peak in 1990. Not in 1993, as that chart implies. But anyway, the rest of it looks right. I will check that later. But the bottom line is that Japan is now underperformed for 32 years. 32 years, ladies and gentlemen. That's quite crazy stuff. Is that cheap? Will that outperform? Quite probably. Questions are coming in. First one's come in. I will come to these as soon as we get to the end of the bit. So asset allocation, as you all know, I've got the money map. Inflation rising, golden value, very nice. Risk on, risk off. And we're in a funny old environment at the moment because, what's happening is that we've got, these are UK gilt prices, the red inflation expectation in red starting to cool off. You saw the natural gas prices a moment ago. The blue 10-year gilts, they've gone up a hell of a long way. We had a little crisis in October, November time. And who knows where they go next. It very much depends whether we have a good understanding of whether inflation's real or not. Very confusing at the moment, because you've got soft economic data, but then you've got pretty strong wage data. Where does that leave inflation? Who knows? China then confuses by putting in a pile of demand just as the central banks are trying to quash it. So we'll be watching that very closely next year. I think the US data is next Thursday, so I'll be glued to that. And these will sort of give us hints of where policy is going. And anyone who says they know what's happening next year, they're overconfident, is what I'd say. I think we know where the value is and we know where the opportunities are, but how it's going to play out, I think we've got to have to watch these things pretty closely. But the most important thing on this chart is the black line, the real interest rate. We've gone from easy money, -2%, free money basically, and I've adjusted this for the US for the RPI CPI gap. So it's a bit of an estimate, but basically -2% real rate is too good to be true, and it was, and we're now back to 1.4, which is much closer to some kind of long-term average. But then going back pre-2008, 3-4 is the norm, and that would really put a squeeze on borrowers. That neatly turns me onto onto the gold price and my model of how to think about gold, the 20-year tips. Right now, the gap 34%, massive, and you have to wonder whether someone's in cloud cookie land. Which one is wrong? Gold or tips? Now, tips can't be wrong, because if inflation's understated according to tips prices today, that just means that the price will go up later, because they are contractually obliged to pay whatever inflation turns out to be. So if inflation is being understated by the tips market, which seems to me very likely, then the tips will catch up with gold. But if the tips are right and inflation is low, then gold's overstating inflation and the gold price will fall. So I think that actually to switch a little bit from the gold into the tips is a prudent thing to do on value grounds, and that's something we've done in the soda portfolio. So I'm very, very comfortable with that idea. Now, the caveat, of course, is when you start to get to the conspiracy theories and start to say, well, look at all the gold in the world. It's only 15% of US stocks and bonds. That chart I showed at the beginning. So surely that's undervalued. And you go, okay, fine, it should be 20, but maybe stocks and bonds are overvalued, and actually gold is fair value, and you still get to an historic average on that way. And just for fun, I put in a little bit of Bitcoin there just to show how what a rounding area it really is on at the moment in terms of being a global macro asset. But that could all change, of course. And then you get the other great conspiracy theory about China's buying all the gold. And actually we get their data on Friday morning at 7 a.m. So I'll be up for that. I'm looking forward to seeing how many ounces the Chinese government pretend they bought or honestly admitted to buying or made up or didn't buy or whatever. Who knows what the information for China really means. But last month they actually showed an uptick for the first time in a long time. And that followed the heavy central bank buying in the third quarter from Kazakhstan, Qatar, and Uzbekistan, Qatar, and Turkey. And that was the biggest central bank inflow in history. So are they going to reprice gold? Are they going to structurally make everyone pay more for gold in the future and break the relationship with tips? They could do that, but there's got to be a continuous flow, a continuous amount of new buying. You can't just have one-off purchase and expect to reprice gold. You've got to keep it moving. So watching the fund flow data from central banks rather than investors is going to be another interesting thing in 2023. Now I've got one more slide on sort of strategy ideas, and we haven't really gone into any detail on themes on any of this so far. We've really, as I say, kept it very high level. But the asset class returns, I just updated this for the year. And it's always quite a fun chart. And by row, blue is the best asset of the year, and dark red is the worst asset of the year. And it's pretty clear to me that last year, 2022, Bitcoin wasn't much fun. But there again, UK inflation-linked bonds weren't much better, and US inflation-linked bonds and the Nasdaq weren't that much better either. And it's funny when you actually look at the bond market over the last few years. It's never been. I mean, 2018 it was blue, light blue. So it went down, but other stuff went down more. But in most years, it's been sort of white or red, showing that bonds have been a pretty lousy place to be for quite some time. So I kind of feel vindicated on that. I just sort of followed yields and went, well, why would you buy something that yields 2% and then 1% and then 0.5% and then negative? It just never made any sense to me. So I've sort of always known this moment was coming, but obviously never put a finger on the timing. And then you look at other asset classes, and over last year, and oil really has started to shine the last couple of years, but then you kind of wonder if that's under pressure as well, and whether commodities, the bull case, is overstated. But of course, my favorite thing on the right-hand side of the slide is bold. ByteTree created the bold index, which is risk-weighted Bitcoin and gold, roughly 80-20 in favor of gold. And I just love the way whenever Bitcoin's the best asset, which is most years, 3 to 4 years, the best asset. And when it is, gold's always pretty lousy. And then when Bitcoin's truly awful, which happens every 4th year by the looks of things on this basis, gold's always pretty strong. I love that intercorrelation, which is just unique to this pair. And you know, if you're a bit of a financial bore like me, then that's sort of what I call financial poetry. And so that's that on the strategy. We'll come back to that in the Q&A. And I apologize, there's a bit of a monologue. Charlie Erith was supposed to help me, but he is on the slopes. So what can I say? This next slide is really a very important housekeeping slide to make sure that you're getting what you want from ByteTree. So at the end of all the emails that you get from us, you'll see that purple box, update profile. Yeah, every time we send a ByteTree premium email, that's from MailChimp. It's not from us. We don't control the mailing lists. We don't control payments. We're all outsourced to secure third parties. We have no data on any of our customers, and that's the way I like it. So this is a MailChimp service. You update the profile, up comes that magic box saying premium members, and it has your email and stuff, your name if you want it in there. It's up to you, and you tick the things you want to receive. And obviously, I'd highly recommend the multi-asset investor. And I'd also think most of you would probably quite enjoy Robin and Raj Pal's AAA report. The ByteFolio and Atomic are also in premium, but these are crypto things, which we'll talk about in another webinar. I'll park it for today. Now, I had a message from a reader today about AAA saying, well, you know, I bought one of the recommendations last month and it went down. It's like, well, okay, this is financial markets, so things go up and down. Obviously, we know that. But what does the AAA do? It's a momentum strategy. It's a very good momentum strategy, but what it's doing is screening the world's ETFs, London-listed ETFs, a bit like what we've got on the data side in ByteTrend, but they've got a methodology which is a bit of price and a bit of price relative, and they look for the leadership. And their observation, which is not just their observation, it's academically proven, that if you own the strongest trends and repeatedly apply this process, you end up with a spectacular result. True, fact. Yeah. The problem is it's quite a painful strategy to follow. So you've actually got to keep doing it, and you can't sort of worry about one of them not working. You just got to apply. And if you do that, as Raj Pal's note, the last note clearly laid out, it shows this kurtosis on the right-hand side, saying that, you know, when you get the big years, that you get these occasional spectacular years. You know, you get many average years, and you get fewer bad years than you do in traditional, you know, by owning the index or what have you. So that really is what the AEA does. You know, is it where you should, you know, back up the truck for that strategy? No, but I think it's very interesting, and I think they write an excellent piece, and I think they're always, you know, a good source of ideas and thinking, because if you don't know what the leadership is, then it's not challenging you to think about what you're missing out on. So if you're going to do FOMO, do it properly, rather than just sort of guess. So that's what I wanted to do in the presentation, and then the next bit I'm going to do is just give you a very quick tour of ByteTree. If I can change screens. Changing screens. There we go. So that is the front page of ByteTree, and you go to ByteTree.com and you should end up on a screen looking a bit like this. You go to research, drop down, there are all the things we do. Blog is the sort of roundup piece we do on Fridays. Crypto, we do Atomic, which is on Bitcoin. ByteFolio, which is the model token portfolio, token takeaway, individual tokens in depth. I'll cover crypto properly another day. But nonetheless, we actually believe in it, unlike the Financial Times and the European regulators. Markets, we've got the multi-asset investor that I write, the AAA done by Robin and Raj Pal, Atlas Pulse once a month by me, over 10 years now on gold, and then occasionally, or once a month, we'll put out Bitcoin and gold chart pack, which really shows you a few things there. Now on terminal, it's a different thing. We click on terminal there and we come to this sort of fun page, and there's lots of things going on in the terminal. This is various live data to do with Bitcoin. I can scroll down over here and I can get some stuff on gold. So my valuation model, for example, will come up here on this screen. We can look at ETF flows on silver. We can do this on various other alternative assets that we cover. And this will pop up any second. And there you have it, the fair value of gold going back 20 years or so. So that model is available to you with data kindly donated from the Federal Reserve. And then the other thing I want to show you is the ETF scores and the commodity scores. If we look at commodities here, we can just sort of sort them. And then right now, it's pretty clear that, you know, at the top of the pack, we've got, you know, silver, nickel, platinum doing very, very well. And as we scroll down to the bottom, we've got, you know, oil and natural gas, palladium. By the way, palladium is one of those metals that's very correlated to the tech cycle. So the fact that it's in a downtrend is telling us quite a lot. I'll also just touch on the ETFs here. We can look at them in dollars. We can look at the ones that have improved over the last 24 hours. And what we're measuring here is trend strength. So 5 stars is a trend that's outperforming the market, and 0 stars is a trend that's basically negative. And you know, it takes most people about 10 years in investing to realize that you want to buy strong trends, not weak trends. In the back of the newspaper, it will have a 52-day or 52-week high and low list, or used to anyway, where people used to look at share price of the newspaper. And, you know, amateurs are always looking at the 52-week low list, thinking there was a bargain, and the people with experience are always looking at the 52-week highs. And there you have it. So this is the ETFs breadth chart. So in blue down here, we've just got some indication that very few ETFs are a very strong uptrend at the moment, and quite a few are in a strong downtrend. But we can take that out of US dollars and put it in world equities, and the picture changes slightly. And you suddenly realize that there's quite a few things to do that are going to outperform the world index. And so really by looking in this blue area here and here, you're looking for things that are starting to do well. That's not a bad starting point. We'll cover ByteTree in more detail another time, and now I think it's a good time to turn to the Q&A. Okay, from David, you recently proposed X trackers Thailand. If my brokers don't offer that, is there any other Thailand tracker or active fund? Not that I know of. Your brokers. So it's a question on brokers. You know, they work for you. You've got to tell them to add these things. I don't know who you're with, but I check on Hargreaves Lansdown and AJ Bell tend to be pretty good. If they haven't got it, they just do it. All of these brokers that don't add stuff, if I were you, I would change broker. That's my view. And if you have broking facilities with a retail bank, then you know literally get your head and stick it in a microwave. It's a really bad idea. You want to go and get a proper broker who can do the job for you reliably and at reasonable cost. And just speaking from experience, and so there you go. There's only one Thai ETF, and that's the one I recommended in that's listed in London. Only one, and there's bound to be a US one, but there are tax consequences. Active funds. There was an investment trust called Siam Selective, if I remember correctly, in 1998, and it traded at a 55% discount to NAV, and it got snapped up by some clever bugger in private equity, and that was that. Ed Barker, the commodities bull case is touch overstated. Why don't you expand on that? Share your thoughts on copper and oil. Well, gold's obviously outperforming copper. I think I put that in a chart recently, or if I haven't, then I should have done. And you can see that on the scores. You know, copper's downgraded recently on the ByteTrends, and gold's up there. You know, all commodities over the long run. If you look at a chart of all the commodity prices over 30 years, they all look the same. They all look highly correlated. They all go up together and all down together. But when you zoom in, you realize they can be a year apart, which in real life is a big deal. And if you're forecasting a sort of US recession, or perhaps a global recession, perhaps many countries not quite sure how it's going to play out, then commodities aren't likely to be fantastic for that. We've got to remember, what is gold? What is inflation? Inflation doesn't mean commodities are going up. Rising commodities can cause inflation, so can wages, so can other things, so can a lack of confidence in a country's financial system. So just because inflation's going up, narrative doesn't mean commodities are strong. But yeah, I love commodities. They're fantastic. But right now I'm a little bit cautious, and so I would say I'm more likely to be selling commodities than buying. I think we've had a lot of gold last year. That's reduced recently. We've had a lot of oil at times. That's reduced recently. So I think that the next 6 months, unless something really changes, I think we'd probably like to have less oil and commodities than we currently have. The general mining thing, all the Rio Tintos and stuff, people, mainstream are starting to get excited about those again, because they're starting to see the cash flow numbers, and they forget that those cash flow numbers are actually linked to commodity prices, which is just one of those things that the street seems to do. They extrapolate for long periods of time. And what are your thoughts on India? Well, Robin likes India in the AA report. I mean, he's always liked India, and I sort of get it. It's always been a market that trades at a bit of a premium. What can I say? A little bit overpriced. Always sort of thought, I don't really need to own it. But I'm sure we're going to end up owning bits of India at some point. In fact, now we've put in a value fund, a dividend fund. There's a bit of India in the portfolio, but we'll see more of that coming through. But am I super bullish on India? Not really, because I've never really gone for growth stories. I always like the value story and hoping for normalization. I always think that's a lower risk way of getting the job done than trying to follow narratives which can be very dangerous. Okay, so we've done Ed, and we've done where are we now? Well, the chance of a strong currency turbulence in 2023-24 over the unsustainability of sovereign debt. I would say somewhere between high and ultra high. The chance. What are the chances? Between high and ultra high, and yeah, it's coming. This sort of thing is coming. It's scary. You just don't know where the bonds are just not yet adjusted to where they ought to be. I mean, you saw those real yields, and I think that's the key number. We're now talking 1.5% real yields, and historically they've been pretty happy at 2, 3, 4. That jump from where we are today to that area, quite painful for a lot of asset prices. But basically, you want to be in short duration assets for that, not long duration assets. Ironically, it makes safe investments dangerous, because typically people think that long duration assets are safe. That's how we've been brought up to believe, but it can turn on its head. So we haven't got much of that going on in our portfolios. So I'm very conscious of that. And if we are going to buy bonds, it's going to be tips. It's going to be linkers, because you lock in the real yield, and actually, you might have a bit of volatility around the interest rate, the long-term interest rate. But actually, the real yield is a thing that matters, because if the inflation comes through, those bonds get repriced, and you can make a lot of money. So I think that definitely I'm more interested in linkers and tips than in conventionals, which still scare the living daylights out of me, because we just don't know if they're going to work. I did try that briefly in the summer, and it bit. We stopped loss quickly, and then we saw what happened a few months ago. So I have tried that once in the last 7 years, I think, with the whiskey and soda portfolios, and it's reminded me how scary duration is when it goes wrong. Thanks, Ernest. Jack. Ultra bullish arguments for uranium. Yeah, well, yellow cake and all that. I don't know how you measure uranium. I've looked at it many times. It's illiquid. When you talk to the serious people in uranium, they say that the spot market doesn't matter. They're all in long-term contracts. I don't know. It's just one of those sort of, I think it's one of those slightly scary narratives. As in, yeah, I really get the idea for nuclear. Don't get me wrong there. I love fusion even more than I'd like fission, although it doesn't quite exist in reality. But I think that the real point is it's just this sort of hype that you buy a pile of uranium, shove it in a safe or in a vault, and then somehow you're going to make loads of money. I've just never seen that work before. This whole, the Dukes cornering the market. I've never quite seen it work, whether it's in cocoa or silver or whatever. And yeah, I think you can be bullish nuclear without buying yellow cake. And I don't really know what it's worth. I don't know what its NAV is. I don't know what its liquidity is like. I like liquid assets. I've learned the hard way over the years. Keep it liquid. Keep it liquid, and if you're wrong, you can change your mind. I'm not convinced that uranium's liquid. And if that yellow cake thing doesn't work too well, then I don't know. I'm not anti yellow cake because I met the chairman, Lord St. John, what's his name? Nice chap, but not quite convinced as an investment for us. Tim, interactive investor. OI. Fine, great. Right, okay. Thanks, Tim. Not quite sure what the point is, but low flat fee on the interactive investor. Marvelous. Okay, well, we like these platforms if they add stuff when they're told to. Thanks, Andy. What's caused the hit to RIT Capital today? Oh, has there been one? I missed it. I think the problem with RIT is that Lord Rothschild's dead. And as he was getting older, I don't know what's caused it, but yeah, I can see what you mean. It's gone down quite a bit. They've got a lot of private equity in there. They've been chasing these deals in Silicon Valley, lots of illiquid assets, don't really know what it's worth. I think they're over-engineering the portfolio. I mean, you take Ruffer, you take capital gearing rather, for RICA and CGT, and then people will say, but RIT's in the gang, and personal assets trust is in the gang. Well, personal assets is kind of high quality equities. So it's lots of inflation-linked bonds, and it's lots of Nestle, but short-dated stuff, and it's lots of Nestle and Diageo and all that, and a pile of gold. And I sort of think, well, we can do that ourselves. And I always felt that portfolio, although it's had a good record over many years, and Sebastian's a good guy, I don't see it for this environment. And then the RIT, I think are over-engineering the back end of the portfolio. I think there's too many tricks and derivatives and funds and overly complicated. So I've never really been a buyer, though I have followed it, but I have no idea what's gone down today. I could look up the news, but I think it'd be boring for the webinar. But yes, it's on my radar, absolutely. Chris, shout out for iWeb. Still £5 a trade. Wow, that's amazing. Thanks, Chris. Rashpal, this is one of ours. Good chat. We had a reader who wrote an article they should pile into emerging market equities on a valuation basis. You see, this is the thing. There's me saying valuation. There's Rashpal talking trends. I told him not to, if following the AAA strongest ranked assets. It's still ranked at the bottom of the pack. But what do you suggest you do as the trend and value are giving a very different picture? Well, in certain markets, you're getting the two aligned. In other markets, you're not getting them aligned. I mean, you're going to get all the emerging markets perfectly aligned in value and trend at the same time. No, I think that's very, very unlikely, particularly these days since they're so uncorrelated. But I think the point here is that Rashpal's right and I'm right. We're doing different things. I'm sort of really thinking about things and trying to find something that's cheap and hopefully made some kind of low signal. Whereas Rashpal is out there trying to identify leadership, and the reiteration is not that I reiterate, it's not each signal is perfect. It's the collective approach of following all the signals over time does well. That's an outcome that you can rely on. Now, it might be that 2023 is awful for trend following. Might be, might not be. But that if it is, then you can guarantee that 2024 or 2025 will be really, really, really good. So it's one of those things that, like many strategies, there's a bit of mean reversion. But Rashpal, you're going to get your own show. We're going to do this together in a few weeks' time. Okay, so I'll move on to Andrew. Your view on silver. Silver is sort of poor man's gold, as it were. The gold-silver ratio the last 2 days, amazingly, has actually risen. So you'd kind of think that we've had this Pretty strong month for gold, as I talked about gold earlier. And we still got gold in the whiskey portfolio, sorry, silver in the whiskey portfolio. And, you know, I am thinking about that. I am questioning whether we should reduce it a bit. It does look a bit too good to be true at the moment. You know, if gold's punchy, then silver's even more punchy. But the mystery is, well, we haven't got the speculators. You know, where are the stackers? You know, all these crazy people who love silver and buy it on leverage. I can't see evidence of them. So there are some unanswered questions in precious metals at the moment, and I can't wait for the data on Friday, because silver will just play whatever's game the gold's playing. If gold's going up, silver will go, I'm in. And if these central banks really are structurally buying gold, then we have to really reconsider that TIPS model and say, actually, gold is being structurally repriced. If that's true, and we start to take that argument seriously, then we need to start thinking differently. So that is a consideration. Lots of questions in 2023, but I just want to make you all understand that I'm worrying about this stuff more than you are. I hope that point comes across. Scott Tanner. According to your site, the value of Bitcoin is 10,492. Does this model come from this figure? Does this mean you're bearish on Bitcoin? Well, I would say I would point you in the direction of Atomic. So we actually built this in the beginning of 2020. I think it went live in late 19 or 2020. We haven't changed it since. It's on a 1 week rolling data, and that 1 week thing is very volatile. The one we tend to refer to in the Bitcoin and gold chart book is a 12-week thing, which is much smoother, and that will give you a fair value much closer to $20,000. There's also a recalibration. So basically, the fair value is taking the NVT, or the network, the transaction value, like the PE for Bitcoin, and we're taking a fixed value of I can't quite remember what it is, but I think it's 10. I think we're doing, so 10, the market cap should be 10 weeks. It's been nearly 3 years since we did this. 10 weeks of spend. Now we do a more dynamic one in the model we publish in Atomic. So I'd focus a little bit more on that. Hopefully next year, if we get some time, we will refresh all the Bitcoin data. But in truth, so few people look at it that it's just kind of gathering dust at the moment. And yeah, I'd love to really go for it and give it another overhaul at some point. But yeah, don't take that one too seriously. But read Atomic for the real insights of what we're thinking. Kath, where do you think we are on the money map now? Where's it going next? You're asking me to predict. That's a tricky one. Well, I think it's all of those things we've been talking about. Our bond, as a bond market risk price, sometimes it's easy to make these sort of calls. Sometimes it's really hard. Right now, it's really hard because we've already had a huge move. You know, so it was pretty easy for the last couple of years to say bond yields are going up, which I've been doing. But now they've gone up. Do they go up again, or is that enough? And that comes back to, have we mastered inflation or not? Now, I was about to go and book a train tomorrow, but you know, there's no train because someone's on strike, right? So someone's on strike, so that means they want a pay rise because they think they work really hard and want more. So yeah, fine, that's what they think. But that is a view that they're going to have, presumably, because there's not 20 people trying to take their job. So therefore, there's still quite a buoyant labour market. That would be one way of interpreting it, which means the inflation forces haven't gone away. But it could be that we have the wages and the commodities go down, and then it goes the other way. I mean, you know, we've got the China coming and the reopening and all that. It's a confusing picture. So where's the money map going? I don't really know. But what I do know is that the thing to stop betting on is quality, you know, bottom left. I think the idea of inflation collapsing and bond yields collapsing, I just don't see it in a 2008 type sell-off. If we have a crisis, it won't be like 2008. It'll be a different shape, more along the lines of what the question about 2 or 3 questions ago, when we were talking about chaos in bond markets and currencies. I think it's going to look more like that. And so, yeah, jumping around higher and lower inflation, less worry about risk on, risk off. I think we're always going to be doing that. It's more about higher and lower inflation. I hope that answers the question. Not a very good answer. Leon, alternative energy and related US and UK equities now very down. Do they offer good value? Energy, Yeah, I suppose they're not bad on value grounds at all. But I've got this sense that there's too many people thinking commodities are the answer, having been the answer last year. And actually, oil made a lower high. So oil was 148 in 2008, and this year, can't remember where it went to, but it was a good $20 shy of that. So you wouldn't call that some sort of strong long-term trend. And what we saw in European energy prices was very much a special situation that hopefully will resolve itself. Fingers crossed, God willing. So, I mean, they're really cheap. I mean, there are plenty of oil stocks around. Was I looking at Harbour Energy the other day, or Cap? One of them was on 1.5 times earnings. I had to double check. Are you serious? But it was, and this is because as soon as they make any money, the government steal it. The UK government. I'm talking about some foreign government with no law courts, but our own government in the UK, which is renowned for good law. So tough one for the oil companies. But yeah, very much on my radar. Very interested in where it's all going. But I think as soon as the puff's out of the oil stocks, then we should probably look to do something the other way again. Good question. Thank you. Eon back at Southbank recommends that readers sell capital gearing rougher because he considers them overexposed to property in particular, and they are over leveraged. Okay, well, I'm not going to say anything negative about Southbank because I like Southbank and I had a good time there and I like the people. But he's incorrect. They're not geared. They're not geared. The investment trusts are allowed to have 15% gearing, but I'm pretty sure in both cases they don't take it up at present. I think he thinks they're geared because it's called capital gearing, which is the name that the Peter Spiller took over 40 years ago and hasn't changed it. So they're not geared. Have they got too much property? Well, they've got things like Granger, which are basically inflation-linked bonds. And the exposure is tiny. The leverage is low in the property companies. So the funds don't have leverage, and within the property companies, these are as safe as it gets in housing with inflation-linked rents and all that. That's why Ruffer owns them. Sorry, Capital Gearing owns them. I did see that note, but I think it's wide off the mark, and I was sort of cringing a bit when I read it. Yeah, wrong. So Andrew, do you think the US Fed are going to keep raising rates until something breaks? Don't know. That's what we're all wondering. Don't know. Probably. Scary, isn't it? But I'm trying to answer that question, and I'll let you know the answer when I figure it out. It's more about figure out how we go through this year. I have no insight into Jerome's private chat, I'm afraid to say. Sorry. The sub would probably be a bit more if I did. John, regarding your concerns, plans for buying linkers, do we not already have means of exposure to them through CG? We do, yeah. We do have quite a lot of exposure through CG and through Ruffer. But they're about, from memory, about a third or something. So there's no reason why inflation-linked bonds shouldn't be a huge allocation. I mean, if real yields are positive, I mean, they absolutely should be, because they're a no-brainer, and they're the closest thing you get to risk-free. Yeah, the pound in your pocket can go down. The bond is all over the place. The inflation-linked bond is inflation plus whatever you're locked into. Bust. That's it. So unless the government is in trouble, and can't pay, then absolutely these are the closest thing to risk-free on this planet. So I'm not remotely scared of having decent exposure to inflation-linked bonds. I don't deem our current exposure to be that high. Yeah, it's higher than it's ever been, but I don't think it's that high. Ernest, still on precious metal alternatives. What's your view on platinum? Platinum, yeah, we owned that a couple of years ago, didn't we? And I think we held it for about 4 years. It just didn't work. And I kept saying it was cheap. And after 10 times of saying it was cheap, I finally threw in the towel, and then it went up. So sometimes these things don't work, and the market gets the better of you. I'm thinking that platinum did get the better of me, and that probably put me off. but it's not a very liquid metal, and it has this interesting way of disappointing. I think platinum's going up on substitution with palladium. Palladium's going down now because it's just had this extraordinarily strong few years, and yeah, there's probably a bit of a relief rally. Maybe there's also a Russian export problem as well. I think lots of platinum comes from either Southern Africa or Russia, I think. So maybe there's something going on there. But I have to admit, I haven't followed the platinum platinum market particularly closely recently. Best sources from whom to buy gold. Oh well, there's a rather interesting thing on the web. So if you go to our website, ByteTree Asset Management, or click on bold, want more, etc., and get to the bit. Provided you're an accredited investor, which is up to you whether you are or not. You know, no one's going to put you over the coals for saying you are if you're not, but it's entirely up to you. And we would only suggest you do if you genuinely are. Then at the bottom of the screen there is an answer to that. But forgive me if I don't say that, who that broker is on air. Obviously, I can tell you the name of the firm would be Killix, but there's a contact there that would help if you want to know that. But thank you for asking. I appreciate that a great deal. Chris, trend following does well until it doesn't, and then it could really be terrible. Yeah, we call that a momentum crash, and I write about that quite a lot. The newly identified trend up will reflect the bear rally, and then it falls further. At the moment, trend following requires care, I feel. I agree. One of the reasons why the whiskey portfolio, and indeed some of the things that the soda portfolio has been purchasing recently, is precisely because we're going through what I believe is a momentum crash. Now, it's not really happening in the US in the way that I thought it might in Q4, early Q4, but it's certainly happening in Europe, and you can feel it. The way the value stocks are doing so well, and all the defensives really are proving pretty useless. But absolutely, the trend is your friend until it bends, is the expression, and I call that the momentum crash, which is a very, very important part of market analysis, I think. But the bottom line is, if you apply a momentum strategy consistently over time, your excess return is, at least 4%. With a sort of boring strategy, and if you have an interesting strategy with a higher turnover, that can be much higher than that. So there is definitely an inherent alternative source of excess return from trend following. But yeah, you're right, it's cyclical. Everything's cyclical, but trend following is particularly cyclical. Thank you, Nathan. We once owned platinum. It's been strong of late. Has your changed? I think Nathan, you probably just heard the answer to my answer a few moments ago, unless you just typed this. Oh yes, sorry, this is in response to me. Yeah, thank you. There could be a physical shortage. Look, I think I need to go and have a look at platinum, don't I? You've got the better of me, guys, ladies and gentlemen. You've got the better of me. I am not sorted up on platinum, so I'll come back to you and I'll make a note of it in the Team Isle Tuesday. Got me. You got me. Okay, thanks, Nathan. Andrew, how do you think the markets will react to a future Labour government? We've already got a Labour government, I would say. I mean, what is a scary Labour government is one who writes out checks like Hugo Chavez, and that would have been Corbyn. But actually, we got Boris and Rishi, and they wrote checks. Now they've decided they want to do austerity again. I mean, make your mind up. But they're stealing assets in the North Sea and super taxing anything that makes a profit. And, we've got a Labour government, I would say. I don't think I'm being flippant. I mean, there's nothing conservative about it. But it's quite a hard time to be a conservative, isn't it? I think that I mentioned last week that I think the only way you can ever have austerity, do it properly, is in a crisis. I was writing last week, I think I mentioned it, that the likes of Iceland and Ireland came out very well, and all the Asian countries, Taiwan, Korea, Indonesia, Thailand, etc. They all came out of that very, very strong, because they had forced austerity, and so what followed was a long, prolonged period of prosperity, and I just can't imagine us not doing that anytime soon. So you know, we overspend, we overtax, we overspend, big government. It might be nice and a nice way to win elections and for the majority to have a nice life, but it ain't the future. It ain't the way to make Europe a dominant power in the future. Thanks, Andrew. Jack, Southbank, many editors continually reiterated how important it is to own gold in your possession as opposed to buy an ETF. Yeah, I mean, I've had this question for years and years and years. And I personally believe that if you can own shares and bonds in stocks and ETFs and funds, then why not gold? I mean, why is gold more likely to be confiscated than anything else? It's a private, these days it's a private asset. There's no formal part of the system. When the Fed, the US, when they banned or confiscated gold in the 30s, I mean, then it was a formal part of the financial system. You know, there was the gold standard. And the gold standard ended for lots of reasons, but the reason I like to tell that is not talked about is technological, because in 1970, when they came off, or 71, they came off the standard. We're getting to a point where the world was able to have fiat money because computers and data traffic started to be pretty sophisticated. Before that, they weren't particularly sophisticated, and certainly if you go back 100 years before that, you know, an ounce of gold was a unit of value in Shanghai as it was in Amsterdam, two major trading ports at the time. And you didn't need to communicate; you knew you had that constant value in these two places. So gold, in a sense, was a financial technology 100 years ago. But as data and communications have improved, then that's paved the way for the fiat system. Yes, you can complain about the fiat system. They also have interest rates too low, so it's too much inflation. I get all that, but as a technology, it works pretty well. And you know, your money in your country in the short term works fine. In the long term, it's probably horrendous in many places. But I you know, so whilst gold's not a formal part of the system, I digress a bit, but it's not a formal part of the system like it was. So there's no reason for governments to confiscate it more than any other asset. So unless you think governments are in the habit of confiscating houses and farms and diamonds and pets and whatever, then why is gold more vulnerable? I know it's a popular story on the internet, always has been, always will be. But I think the ETFs are a great innovation. I think they're a huge positive force for the private investor. You try and track a complex index without one. They're fantastic. And gold solves a legal problem, because before the gold ETF, owning gold, you know, you had to go to some shop or something and buy a physical piece of gold. And that physical piece of gold is not particularly useful in your portfolio because it's no longer part of your portfolio. It's like having a painting. Which is fine, it's part of your wealth, but it's not part of your portfolio. To me, gold is a liquid asset, and that's one of the wonderful things about it. So if you own it in physical form, then you remove that ability to swap it for something else. So yeah, conspiracy theory. Maybe I'll be proved wrong one day, but I don't think we're quite there yet. So yes, I like gold ETFs. Ed, this is probably really amateur, sorry, but how do I buy tips? Well, in Soda we had a recommendation the other day. I won't say it, but I think the title was Gentlemen Prefer Bonds. That was the piece I wrote a few weeks ago. If you look that up on the ByteTree Premium, you'll find it, and there'll be the recommendation. And the clue is it starts with C. Autonomous attendee. You used to have a Genepi portfolio just for Bitcoin. So I miss Genepi. Well, look, you're in ByteTree now. Come on, we've got crypto coming out of our ears. You've got Atomic, which is basically Genepi, which is Bitcoin only. Then we've got Bytefolio, which has got loads of tokens, and it's got a good process behind it to identify the future of crypto. You know, I'm of the view that 99% of crypto tokens are worth zero, and some of them will be the Googles of the future. And some people think that all the tokens are valuable. Some people think none of the tokens are valuable. I think most people think that none of the tokens are valuable. There's actually a bit contrarian to think there's any value in the space at all. I think there's just so much innovation, and the financial system will one day be run off infrastructure that's currently being tested on crypto. Don't laugh, having seen all the explosions in the market last year. But I really do. I think the underlying technology that's being built is extremely impressive on so many levels. And I just think the old system's clunky. I mean, just look to all these, you know, has so-and-so got this ETF listed on their site and all that. They won't do this, they haven't done that. I mean, the crypto system, they'll just list millions of things and it just works. The problem it's missing is, you know, it needs regulation. And so people stop making ridiculous mistakes that they keep on making. VCTRA, this looks like a private key. Has Bitcoin peaked? Does Binance have to go down before crypto stage recovery? Will CBDs ultimately take over the space? Has Bitcoin peaked? Well, it did peak. I personally am pretty upbeat about Bitcoin. I don't know if you spotted the ByteTree crypto signal today. We had ETH 5 out of 5 against Bitcoin, showing that there's a bit of buoyancy coming back into the space. So that was quite nice to see. If Binance goes down, then I think crypto is in a bit of trouble because there'll be no liquidity. And so we'll have to wait until you know, local Bitcoins starts up again, and we can all go to the Nag's Head in the East End and swap cash for Bitcoins and all that sort of thing, bringing back the old days. But I don't think Binance is going to go down. I certainly hope it doesn't go down. CBDCs are a spin-off of crypto. It's inspired by crypto. One of the fintechs that I've just been talking about, saying how this is the future of finance. It's all being invented by crypto. Everyone's just desperate to call it something else. But actually the technology underlying a CBDC is basically blockchain. And yeah, it's just the same old crappy fiat money, you know, your pounds, dollars and euros as you've got at the moment. They just happen to be a bit more buoyant electronically. So I'm not excited about them, but I do see them coming. I hope. We wrote a piece on this a year ago on ByteTree and blog. And I think it's got Bitcoin in the title if you want to look it up. It's my open letter to Rishi Sunak. And that was, you know, the conclusions then are the same as the conclusions now. Let the private sector deal with this, please. Keep it away from the public sector, because I don't want the Bank of England getting anywhere near it and our data. And it's a complex tech project. It's unquestionably an area where, you know, competing private sector firms should be allowed to thrash it out and let the winners emerge. And yeah, there's something wrong with digital money on that basis, digital fiat money on that basis. But there's a lot wrong with the government having some scary controlling thing. Great for China and Russia, terrible for us. Bitcoin dead? No, I love it. Toby, is your enthusiasm for BTC undimmed? Do you think it will rise again? I do. I think there's an inevitability about that. I mean, you only have to watch Arnold Schwarzenegger going to Mars when he buys a thing for 2 credits, you know, and it's sort of that's where it was going, wasn't it? And it just happened to look like Bitcoin. And what is the intrinsic value of Bitcoin? I'll tell you what it is. It's 0. It's worth 0 intrinsically, but the network value is huge. And that's what I think people don't understand. And what's the difference between a bar of gold and a Bitcoin from intrinsic value basis? Well, Bitcoin's intrinsic value is 0, and gold's intrinsic value is materially lower than its current price on the screen. It's intrinsic value. I'm not talking about my model. I'm talking about its pet rock, illiquid, non-financial value. So if we just look at gold and say, that's shiny and beautiful, I'll buy a necklace or a bracelet or something, and we didn't actually have the financial side of gold, the price of gold would be much lower. Yeah, I don't know what it would be, but it'd be much lower than it currently is. And so the gold price as a financial monetary asset is the intrinsic value plus the network value, the liquidity value, the fact that 5,000 years of history have a belief system where all the central banks know that that's how they engage behind closed doors, where they don't want to face each other's money. So that makes sense, and that's proven. And Bitcoin's the same thing. It's just without the intrinsic value, because if everyone stopped using Bitcoin, there'd be nothing left. If everyone stopped using gold, you still have a nice shiny piece of metal. Yeah, but make no mistake, that doesn't make gold intrinsically valuable at $1,800 an ounce. No, that intrinsic value could be $1,000 lower than the current price. So Bitcoin is valuable because it's liquid. Litecoin, Dogecoin, Shiba Inu, Bitcoin Satoshi Vision, Bitcoin Cash, all the million clones of Bitcoin are worth zero. Yeah, there's only one network, and that network is extremely valuable. And I think it's going to win through. I think there's an inevitability about it. And yeah, I'm not as excited about it as I was in 2013 when I first went gooey over it. But of course not. It's played out largely, but it's now part of the system. It's part of the structure. And we've seen all the meme stocks collapse in the last few months. And Bitcoin's held up through that. If it was going to zero, after what we've been through last year, I think it would be much worse than it currently is. And the network's alive and well. I mean, go to our data, and our calibration might not be perfect, but the network's alive and well. What the price of Bitcoin is broadly aligned to how much dollar value is transferring over the network. It's not a thing. Bitcoin is not a thing. It's a part of a network. And what's my favorite analogy? You take something like let's go and steal the code for Facebook, yeah, or TikTok or whatever, or Twitter or something. We steal the code and we say, we'll launch our own. We'll cut and paste the code and launch our own. We'll call it ByteTree social network. That's great, but unless we've got hundreds of millions of people sending pictures of dogs and cats to each other, then it's going to be worthless. So you can steal the code, but you can't steal the network. And Bitcoin has a monopoly on the network side, and the code effectively has no value because you can just cut and paste that. But you can't cut and paste the Bitcoins, and you can't cut and paste the network. So that's the bit that's valuable. And I think that's where people are confused as to why this thing is quite so special. So, my gosh, 1 hour and 6. We'll have to learn to speed up. Ladies and gentlemen, thank you very much for your time. And thank you for signing up to ByteTree Premium. And, write to me, charlie.morris@bytetree.com.